Welcome from me, Guy Monson, to our regular 6-minute strategy. As the Trump White House is discovering, Iran presents a very different challenge compared with past theatres for Trump, such as Iraq, Venezuela or Syria. Iran has had a distinct Shia identity since the 16th century. In that sense, the Islamic Republic still retains a degree of legitimacy among its supporters. The country also has a deeply entrenched system of governance as an institutionalised, authoritarian theocracy. So it is perhaps not surprising that its leaders felt confident enough to walk away from last weekend's talks with the US without a deal. Against this backdrop, the ceasefire remains fragile, but it is holding for now. It seems also that communications behind the scenes are apparently still ongoing. Against this backdrop, markets have been remarkably well behaved, given the scale of the energy shock and the military response. Indeed, global equities have recovered and are up for the year, while equity volatility has fallen back below its 20-year average. Perhaps most surprising of all, though, is that global earnings estimates have actually climbed since the conflict began in the end of February. The question for the slides ahead is clear then. Can this calm across financial markets last? So let's begin by looking at the left-hand panel, which has the performance of global equities for the year to date to the right of that dotted line. And you can see we're actually higher than we were at the start of the year. Indeed, if you look at the peak of equity markets at the end of February as the Iran-US crisis began, we're only a few points off that level today. In a similar way, the message is coming from the VIX index, this famous volatility index of the S&P 500. It shows a peak in volatility for the great financial crisis in 2008, falling to a peak at COVID in 2020, then the Ukraine invasion, then a much smaller peak we're seeing here for the Iran-US war. And in fact, with recent movements, we're now down at 19%, which is below the 20-year average. So we have a hot war and an energy crisis in the Gulf, and we're below the 20-year average for equity volatility. Extraordinary. So why is this? Well, the first general point is I think we've always believed in rather muddle-through, protracted low-intensity conflict than the sharp crisis others have talked about. We've seen the air campaign degrade but not eliminate the Iranian military. Diplomacy hasn't pulled off a coup yet, but talks are continuing. Brent we see at $80 under this scenario by end 2026, and the oil and insurance markets come into play to restart shipping across the Straits in the months that follow. We could be wrong, it could be a severe outcome. Destruction of region-wide energy infrastructure, the states clears due to mining, and energy bypasses through the east-west pipeline of Saudi Arabia, interrupted by the Houthis. So that's the worst-case scenario. We're not there. This is our 80% probability. What other factors are coming into play, and why are equity markets so comparatively well-behaved given this backdrop? Well, first of all, in other major supply disruptions, though they're much smaller than they are today, the 2026 barrels at risk is about 50 to 20 million barrels per day. That's far larger than anything we saw even back to the 70s. But that's barrels per day at risk. The IEA distinguished between this, what they call risk flows, and net loss supply. That's much smaller, in part because Saudi is still able to pump so much through that east-west pipeline that it's mitigating a lot of the other losses through the Straits. Secondly, of course, the energy intensity of Western economies has collapsed. If you look at the US there, the energy consumption per dollar of US GDP, it's fallen by almost 2/3 since the 50s and the 60s. In other words, smarter cars, more efficient industry, just a general electrification has produced a huge offset to the impact that we would normally have expected to see from an oil crisis 30 or 40 years ago. In addition, of course, for the US, they have abundant natural gas from their shale fields, which means their gas prices are actually falling. Yes, they're rising in Europe, but from a US perspective, those energy prices are much more bearable. Thirdly, of course, we've seen an astonishing performance for global equity earnings. For 1 year ahead, we're now expecting profit growth of 24%, and those revisions just start getting stronger. Now, part of that is flattered by much stronger energy earnings from the big oil supernationals, but other other areas of the market are continuing to produce robust and strong growth. In the right-hand side, I put where, despite all the problems and challenges, Mag 7 EPS growth looks like it'll be another boom year of around about 35% growth for the year ahead. And with 600 to 700 billion of capex spend for AI, mainly data centers, that'll ripple out into the rest of the economy. So let's wrap this up. Well, our base scenario is for an acute phase of the war to end by the end of this month or so, but with ongoing skirmishes and disruption. The inflation rate for the Western world to climb to 3 to 3.5%. That's painful, but it doesn't need to trigger a recession for most developed economies. Yes, we'll see a negative impact on growth. The US is probably least at risk, but it's not likely to really offset the underlying momentum of the economy, and a 70-style recession is right off our scenario planning for the moment at least. Yes, financial conditions will tighten, but more because central banks leave their rates unchanged rather than actually raising them. So of course there are risks. Yes, we could have serious energy disruption. That could lead to a recession in energy importing countries. Secondly, those AI returns could prove elusive, having an earnings shock across global equity markets. Liquidity too could dry up, and that private credit squeeze could be a harbinger of something much worse. Well, those are not our base pictures. We're retaining our overweight equity position, really supported by those extraordinarily strong earnings numbers that you saw in the slides. Thank you.